You have an extra $400 sitting in your account this month, and whichever one of two buttons you press with it determines whether you retire with an extra $200,000 or a paid-off house a decade early, and most people press the button without ever comparing the two. You've had the mortgage for a few years now, long enough that the closing paperwork excitement has faded into just another line item on the monthly budget. The rate is locked in, the payment is predictable, and lately you've found yourself with a little breathing room in the budget. Now comes the question that never quite gets a satisfying answer anywhere online. Throw that extra money at the mortgage, knock down the balance faster, or send it into an investment account instead and let the market do the work. Both feel responsible. Both feel like the mature, adult version of managing money. But they are genuinely different bets, built on different assumptions about the future, and the correct answer depends on numbers most people never actually sit down and calculate. There are 5 things that actually decide which button is right for you, and once you see them laid out, this stops being a coin flip between two responsible-sounding choices. Point 1, what each option actually guarantees, and what it doesn't. Point 2, what happens when you run both paths forward, and the risk that averages quietly hide. Point 3, being fair to both sides, the value of a guarantee and the value of discipline. Point 4, taxes, and the correct order to send your money in. Point 5, 2 homeowners, and the real question that decides which one you are. Let's start with point 1. Point 1, what each choice actually guarantees. Let's start with what each choice actually guarantees, because that word, guarantee, is doing a lot of quiet work in this comparison. Every extra dollar you send toward your mortgage principal earns you a return exactly equal to your mortgage interest rate, guaranteed, with 0 volatility and 0 risk of loss. If your rate is 6%, every extra dollar of principal you pay off is functionally earning you 6%, risk-free, for as long as you would have otherwise been paying interest on it. That's a real, mathematically precise return, and it's one of the only genuinely guaranteed returns available anywhere in personal finance. Investing that same extra dollar instead offers no such guarantee. The stock market's long-run historical average return sits around 10% annually, comfortably higher than most mortgage rates. But that average is built from decades that included years the market dropped 30 or 40%, alongside years it gained 20 or 30%, smoothed out only by staying invested through the entire stretch. The extra dollar you invest instead of paying down your mortgage might genuinely out-earn your mortgage rate over time. It might also be worth meaningfully less than what you put in any given year you check the balance, something a mortgage payoff can never do to you. Here's the actual math worth running before deciding anything, and it comes from research conducted directly on this exact question. Fidelity studied when prepaying a mortgage actually makes more financial sense than investing the difference, using a 27-year time horizon to identify the real threshold. Their research found that for a typical investor holding a balanced portfolio, paying down a mortgage early only became the mathematically superior choice once the mortgage rate climbed above roughly 3.5%. For a more conservative investor closer to retirement, someone who can't afford the same market volatility, that threshold shifted up to around 2.9%. In today's environment, with average mortgage rates sitting well above 6%, that threshold has clearly been crossed for a large number of homeowners, at least when you're only looking at the pure math of expected returns. It's worth being precise about what that threshold actually represents, because it's easy to misread as a simple, universal rule. It doesn't mean prepaying below that rate is always wrong, or that anyone doing so has made a mistake. It means that, purely on the arithmetic of expected long-term investment returns weighed against a guaranteed interest saving, the investing side of the comparison tends to come out ahead once the mortgage rate sits below that specific range. Above it, the guaranteed savings from paying down the loan starts to outweigh the higher but genuinely uncertain expected return from the market. A mortgage sitting at 6 or 7% today lands solidly on the prepayment side of that threshold, in a way it simply wouldn't have during the years when rates sat closer to 3%. This is the first correct step almost nobody actually takes before choosing between these two options. Compare your specific mortgage rate against a realistic, conservative estimate of expected investment returns, not the best year the market has ever had. The incorrect step is assuming the stock market's long-run average automatically beats any mortgage rate simply because 10 is a bigger number than 6, without accounting for the fact that one of those numbers is guaranteed and the other genuinely isn't. Point 2, running both paths forward, and the risk averages hide. Let's actually run both paths forward and watch what happens over time, because the theoretical comparison and the lived experience of each choice look different in practice. Picture yourself sending an extra $400 a month toward your mortgage principal, on top of your regular payment, at a 6% interest rate. Depending on how far into your loan you already are, that extra payment can shave years off your remaining term and save tens of thousands of dollars in interest you'll simply never pay. It's satisfying in a very direct way, watching your remaining balance shrink faster than the amortization schedule ever promised, and there's a real payoff date now visibly closer than it used to be. Now picture yourself investing that same $400 a month instead, in a broad market index fund. At a 7% average annual return, a reasonably conservative planning assumption below the market's long-run historical average, that monthly investment grows to roughly $69,000 after 10 years. Compare that to the interest you would have avoided paying by directing the same money toward a 6% mortgage instead, and depending on how much of your loan term remains, the invested dollars often pull ahead over a long enough horizon, purely because the rate gap between roughly 7% expected returns and 6% guaranteed savings, while narrow, compounds in the investor's favor over enough years. Extend that comparison out to 20 years instead of 10, and the gap widens considerably, in a way that reveals just how sensitive this decision is to how long you actually let either strategy run. That same $400 monthly investment, compounding at 7% for 2 full decades, grows to roughly $204,000. Meanwhile, the total interest saved by directing that same money toward mortgage prepayment instead, while still meaningful, typically falls short of that figure once you account for the fact that extra principal payments made later in a loan's term save proportionally less interest than payments made earlier, since less interest is accruing on a smaller remaining balance by that point. This is exactly why the time horizon you're actually planning around matters as much as the rate comparison itself. A short remaining time horizon tends to favor the guaranteed, front-loaded savings of prepayment. A longer one tends to give compounding more room to work in the investor's favor, assuming the money genuinely stays invested through the inevitable rough years along the way. Here's where the correct step and the incorrect step really diverge, though, because that narrow gap is exactly where sequencing risk becomes the deciding factor rather than the average return alone. If the market drops significantly in the first few years after you start investing instead of paying down your mortgage, and you needed to access that money during the downturn, for a job loss, a medical expense, anything unplanned, you could be forced to sell investments at a loss precisely when you can least afford it. A mortgage prepayment carries no equivalent risk. Once that extra principal payment is made, the interest you avoided paying on it is permanently avoided, regardless of what happens to the stock market the following month. This is exactly the kind of trade-off Wade Pfau, a retirement income researcher and professor at the American College of Financial Services, has spent years studying from the liquidity side of this exact question. His broader body of research consistently emphasizes that paying down debt faster isn't automatically the mathematically optimal move just because it feels more conservative, and that locking money into an illiquid asset like home equity can quietly remove exactly the financial flexibility a household needs most during a difficult stretch, even when the interest rate math technically favors the faster payoff. The reverse point matters equally here. Investing instead of prepaying only actually wins if that invested money stays invested through the inevitable rough patches, rather than getting pulled out at the worst possible moment out of necessity or panic. Pfau's broader work on retirement liquidity makes a related point worth carrying into this decision even years before retirement becomes relevant. Home equity, once built through extra principal payments, is real wealth, but it's fundamentally different from wealth sitting in a brokerage account, because accessing it generally requires either selling the home outright or taking on new debt against it, a home equity loan or a cash-out refinance, each carrying its own costs, approval requirements, and timing delays. Money sitting in an investment account instead doesn't share that constraint. It can typically be accessed within days, without needing to convince a lender you still qualify for a new loan during whatever circumstance made you need the cash in the first place. Point 3. being fair to both sides, the guarantee and the discipline. Let's be fair to mortgage prepayment here too, because it isn't automatically the mathematically inferior choice just because the numbers sometimes favor investing. There's real value in a guaranteed outcome that a purely mathematical comparison doesn't fully capture. Once extra principal is paid, it cannot be taken away by a market downturn, cannot be eroded by a bad decade in the market, and permanently reduces your fixed monthly obligation for the remainder of the loan, which matters enormously if job stability or income predictability is a genuine concern. The correct step is recognizing that a guaranteed 6% return and an uncertain, higher expected return aren't actually the same type of asset, even when the numbers on a spreadsheet look comparable. The incorrect step is treating them as interchangeable simply because they can both be expressed as an annual percentage. There's a behavioral piece worth naming honestly too, because it changes which choice actually gets followed through consistently over years, not just which choice wins on paper in a single calculation. Extra mortgage payments happen automatically once set up, structurally difficult to quietly skip or redirect elsewhere without an active decision to change them. Money earmarked for investing, sitting in a checking account waiting to be transferred, is considerably easier to quietly spend instead. A nicer vacation, a car upgrade, a series of smaller purchases that individually seem harmless but collectively erase the $400 that was supposed to be invested every month. If you know yourself well enough to recognize that a checking account balance tends to disappear into everyday spending rather than actually reaching an investment account, the forced structure of extra mortgage payments has real, practical value beyond what the math alone suggests. There's a way to capture much of that same forcing structure on the investing side too, worth knowing about before assuming the discipline gap between these two options is unavoidable. Setting up an automatic transfer that moves the extra $400 directly into an investment account on the same day your paycheck arrives, before it ever sits in a checking account long enough to feel available for everyday spending, replicates much of the automatic discipline a mortgage payment naturally has built in. The correct step, for someone drawn to investing but honestly worried about follow-through, is automating that transfer immediately rather than relying on a manual transfer they have to remember and choose to make every single month. The incorrect step is assuming good intentions alone will reliably move that money before it quietly gets absorbed into everyday spending instead. Point 4, taxes, and the correct order to send your money in. Let's bring taxes into this too, because the math used to tilt slightly differently than it does today. Mortgage interest is only deductible if you itemize your deductions, and since the standard deduction was substantially increased under recent tax law, the majority of homeowners no longer itemize at all, meaning the tax benefit that used to make carrying a mortgage balance longer somewhat more attractive has largely disappeared for most typical households. On the investing side, money placed in a tax-advantaged retirement account, a 401k or an IRA, grows either tax-deferred or tax-free depending on the account type, an advantage a mortgage prepayment simply can't replicate, since paying down debt offers no equivalent tax shelter of its own. This is precisely why the correct step for a lot of people isn't choosing one option exclusively, it's sequencing them deliberately based on where each dollar actually delivers the most value first. If your employer offers a 401k match, that's typically the correct first stop for any extra money, since it delivers an immediate, guaranteed return, often 50 to 100% on the matched portion, that neither mortgage prepayment nor unmatched investing can come close to touching. After capturing the full match, the comparison between mortgage prepayment and additional investing becomes the real decision this comparison is actually about, and the answer depends heavily on your specific mortgage rate relative to realistic expected returns, exactly the calculation most people skip entirely. Point 5, 2 homeowners, and the real question that decides it. Let's look at 2 different homeowners to see how this plays out differently depending on who's actually asking. Picture someone who refinanced or bought during a period of unusually low rates, sitting on a mortgage at 3%, with a stable job and a fully funded emergency fund already in place. For this person, Fidelity's own research points fairly clearly toward investing the extra money instead of prepaying, since a guaranteed 3% return sits well below a conservative expected investment return, and the gap between the two is wide enough that it would take an unusually bad multi-decade stretch in the market for prepayment to have actually been the better choice in hindsight. Now picture someone who bought more recently, carrying a mortgage closer to 7%, in a job they consider reasonably but not perfectly stable, with an emergency fund that covers essential expenses but not much beyond that. For this person, the guaranteed 7% return from prepayment sits close enough to a realistic conservative investment estimate that the certainty of the guaranteed return, combined with the peace of mind of a shrinking fixed obligation, makes prepayment a genuinely reasonable, well-supported choice, not merely a consolation prize for someone unwilling to take on market risk. Neither homeowner is making a mistake by landing on a different answer. The mistake would belong to either of them defaulting to whichever choice is more popular in general personal finance conversations, without ever actually comparing their own specific mortgage rate against their own realistic expectations for what the alternative would likely deliver. So which choice is actually correct for you? The honest answer starts with a question that has nothing to do with your mortgage rate at all. How solid is your emergency fund, and how stable is your income right now? If your emergency fund is thin, or your income feels genuinely uncertain, the correct first step is neither extra mortgage payments nor additional investing, it's building that cushion first, because both prepaying a mortgage and investing share the same weakness during an actual financial emergency. Neither one is quickly accessible without cost or penalty. Once that foundation is solid, the comparison between the other two options becomes worth running in detail. If your mortgage rate sits below roughly 3 to 4%, historically low by any standard, the math from Fidelity's own research points fairly clearly toward investing the extra money instead of prepaying, since your guaranteed return from paying down the loan sits meaningfully below what a conservative investment return would likely deliver over the same years. If your rate sits above 5 or 6%, closer to where a large number of current homeowners actually are, the guaranteed savings from prepayment becomes considerably more competitive against realistic investment expectations, and the decision leans more heavily on your own tolerance for market volatility and how much you personally value the certainty of a shrinking, then eliminated, monthly obligation. The incorrect step, the one that quietly costs people the most over a decade or more, is picking whichever option feels more emotionally satisfying in the moment, the thrill of watching a mortgage balance shrink or the excitement of watching an investment account grow, without actually running the specific math against your own mortgage rate and your own realistic expectations for investment returns. The correct step is treating this as the genuinely close, rate-dependent calculation it actually is, rather than assuming either answer is obviously correct for everyone regardless of their specific numbers. None of this required predicting exactly what the market will do over the next decade, or exactly how long you'll stay in your current home, questions nobody, including professional forecasters, can actually answer with confidence. It required one honest comparison between your specific mortgage rate and a realistic, conservative estimate of expected investment returns, one honest assessment of your own emergency fund and income stability, and the willingness to treat a guaranteed return and an uncertain one as genuinely different things, even when they can both be written down as a single percentage. That's the entire skill. Most people never apply it, not because it's complicated, but because nobody ever framed an extra $400 sitting in a checking account as a decision this specific math had already been worked out for. You have an extra $400 sitting in your account this month. Now you know exactly which button actually makes sense for your specific rate, and exactly why the answer was never going to be the same for everyone.